Good afternoon, financial professionals. This is Mike Pinkans, a Regional Vice President with E4 Insurance Services, coming to you live from sunny, beautiful, and hot Clearwater, Florida. Welcome to the Brew, building relationships every week. I am your substitute host this week. John Florence, our Senior VP of Marketing, is not available, but I hope I can do John right. Thanks for tuning in today. For those of you on the Brew for the first time, we always like to start our Brewcast in celebrating today's National Day. Now, today is National Idaho Day. I know two things about Idaho: russet potatoes, which I guess there's probably a potato day somewhere, some other day, and Coeur d'Alene, Idaho, which I think is absolutely beautiful. It's World Telecommunication and Information Society Day. I don't know if that has anything to do with ChatGPT. National Cherry Cobbler Day, National Graduation Tassel Day, National Walnut Day, World Hypertension Day, Emergency Medical Services for Children Day, and National Pack Rat Day. Kind of an interesting day for all of these today. On today's Brew, I'd like to welcome Lincoln Financial Senior Consultant of Advanced Sales, Ryan Patton. Now, Ryan has over 10 years of experience in the advanced sales arena with not only Lincoln, but another top quality insurance carrier. And Ryan is going to share with everyone today planning alternative considerations and other best practices when we're working with closely held family businesses. And specifically, Ryan's going to talk about a recent court case which had business assets coming back into the estate. And of course, you know, we always think, Ryan, that a business is separate from someone's personal estate. So this is really timely. We always want to separate, you know, business assets from personal assets. We certainly don't want them includable in the estate. So I'm glad you were able to join us today and kind of share your expertise to help everyone on today kind of avoid this problem for their clients. Welcome, Ryan.
Hey, thanks for having me, Mike. Yeah, and I'm right there with you. It makes me want to grow back hair. It's that frightening. So, how about I go ahead and pop up our session for today? And yeah, as Mike mentioned, you know, I want to chat with everybody on a hot topic that came out not too long ago, and it's this case right here. This is the Connelly case. Came out actually in November. So if you haven't heard of it, that's probably why. This case for me is pretty frightening, to say the least. We'll go ahead and dive in for the sake of time. But yeah, it's very frightening. So I would think of as we're going through this discussion, think of those closely owned family businesses, especially out in kind of the Midwest and even out to North Dakota, things of that nature. A lot of family businesses that I've worked with are farms. They tend to have family succession issues, and gosh, talk about a perfect storm. We do not want them to be the next Connelly case, to say the least. So I think of a few folks as we're going through this, but general overview of what happened with Connelly is this case actually went through the estate planning side. So a little different progression from a tax court perspective, but the general flow here is we had a main operator, Michael and his brother, Thomas. So think of all of those closely owned family businesses that you work with, very similar. Michael was the main individual running the operations day to day. Thomas was more of the silent partner. He was there, but it was more of the family, I'm there for you type of operation. So Michael was very active. And as you could imagine, Michael being the active individual, his son was going to be the active individual at the time of Michael's death, or at some point in the future where we transition the business down to his son in that active capacity. So as most business owners would do, they wanted to keep things simple. And to do that, they formed an entity style buy-sell, or folks out there might know of those as redemption style. That generally is going to have the business own the insurance on the individual. So Michael, in this case, it's going to pay for that coverage. It's going to be the beneficiary of that coverage. It's going to facilitate everything to do with his eventual buyout from his estate. So very, very effective, very easy from that perspective, allows the business to have the cash value as well. So a lot of nice planning perks with that. This case, though, is a little bit of the maybe why not to do that. So as we would anticipate, Michael passed away. The business received $3.5 million of death benefit coverage. Thomas, through his analysis of the business and maybe on the back of a napkin from the way the court made it out to sound, he determined that the value of the business was 3.86 million, which is just a shade above what the actual death benefit that came to the business was. The court said, we don't have any issues with the actual money from the death benefit going into the business. We're going to treat that as tax-free. Uh, those funds are going to go directly into the business, but you didn't follow this IRC. If you look on the left side of the screen, IRC 2703, which is what binds the IRS to the actual buy sell, the terms and the value. You didn't do other things like a certificate of value, which is a simple sheet that most businesses should do each year, which is, I'm going to attest to the new value of my business. We're going to agree to it as shareholders. We'll file it in the back of our books, and we're good. They didn't do a lot of the things that you should do as a business owner. And because of that, the IRS said, death benefit still tax-free. We honor that. We agree that it goes to the business tax-free. However, since you didn't follow a couple of the metrics that make you a formal business, we're actually going to add the death benefit proceeds to the overall value of your estate. That's pretty frightening. So they went from roughly a $3.86 million value of the business. They added an additional $3 million on top of that from an estate tax perspective. So in this case, again, not a big issue. No state estate taxes, no real estate taxes from a federal perspective. But imagine those businesses that you work with that are 10 million. And we've got 5 million of coverage on the owners. Geez, we're heading into sunset. Estate tax levels are going to fall. This presents a very large issue where we typically would have had an estate that would be tax-free. Now it might be taxable just because of the way that we own the insurance. So very, very frightening. A little bit of a deeper dive for you just to have a good sense of what goes into this. The requirements that are on the screen, these 6 different items, this is a little detail on that 2703 requirement. Biggest ones that I would say to look to is the very top one. Did I actually have an agreement that was a little more sound? So I put in certain stipulations. I have certain buyout terms. I know what I should be doing. Was that agreeable? Does it make sense? Is it kind of that arm's length transaction? The other big one that the IRS held or the court system held was they missed at least 1 or 2 of these that are on the screen. And that top kind of call it 1 o'clock, they said that if you miss any of the other ones, we're going to deem that life insurance death benefit was really acting as a device to transfer more wealth to the family for less than that full and adequate consideration. That's why we're going to add it to the value of your overall estate. So it's easy. If you fail one, you're likely to fail that one as well. And that's what's pretty frightening. I have no doubt that this court case will likely be appealed and it will likely be overturned. The thing that frightens me the most with this one, and the reason I think that this is such a great opportunity to go to not only your book of business that you have these redemption style buy sells in place, but also use it as an opportunity to go to your centers of influence. Where I was at, where I initially had a deeper dive on this, was a CPA symposium. So folks that looked a lot like me, no hair, they were pretty shocked as well. They hadn't heard of it. A lot of attorneys haven't heard of this as well. So use this as an opportunity for you to comb their books with them to uncover some of these opportunities. And we certainly don't want to be the third. So this is actually the second case fairly recently. A prior case was actually called Blout, where similar circumstances where we had life insurance includable in the estate due to the business transaction. Connelly's the second. So it is on the radar, to say the least, from an estate perspective. The other thing I'll just briefly touch on is more with that 2703. Some of the things that the court said were okay were actually the preservation of a family business. So that is a bona fide reason to have this type of buy sell, which is something that we would promote as well. The thing that the IRS or the court system actually said was a little more scrutiny is anything to deal with intergenerational or intra-family transfers. They're going to be looking at those pretty heavy. So what the court system has done effectively is given us a target. These are the folks that we should be addressing. If you have any sort of redemption style buy sells in place, certainly a good opportunity to say, maybe we should shift over to a cross purchase just to make sure we're not running into a foul with this Connelly case. Or maybe we should do something a little more sophisticated because we have a larger pool of owners. Maybe that's a life insurance LLC. So a separately owned entity that's going to facilitate the buy sell for what we wanted as a redemption style. So look to life insurance LLCs coming out of this. Look to cross purchase if we can as kind of that quick band-aid for this situation. But know that this is a case that is certainly rocking our world a little bit and pretty frightening if you can get it wrong. So use this as leverage prior to 2026 as well. Make sure that they don't have any issues with our potential sunset of those estate taxes. So that was my quick brew for you this morning, Mike. Wanted to cover that topic, and any questions that pop up, I'm happy to dive through.
Ryan, that was really short and sweet, and I was just taking a couple of notes. You kind of alluded to this, but what an opportunity not only to go back to your own book, but for prospecting business owners, because the decision, as you said, came out in November. And it's a great opportunity to say, are you aware that this happened? Do you have do you have an entity purchase kind of buy sell? You may need to change, or you may need to make sure your documentation's up to date. You may need to make sure your valuation is up to date, but at least it just gets the conversation going. And I was just thinking of even my own CPA, who is long retired, but he does my taxes down here as one of the 10, so he can keep his license. But he's a consultant now, and he's working with businesses. And I'm thinking, wow, I need to go back to him today and say, what do you think about the Connelly case? And see if he even recognizes that. And then, kind of say, we got to sit down, because I'm sure you have business owners that you have consulted with that may fall into this trap. So what a great, not only a very short presentation as far as, what did go wrong, which is great, easy to understand, but what an opportunity to really be a hero in presenting, something that didn't go properly in the tax courts that you can help fix as a producer. So really great job.
Yeah, absolutely. Yeah, it's one that's frightening to me, and it's as simple as, have you updated your buy sell or reviewed your buy sell given the Connelly case? Or have you had a valuation given the Connelly case? Very easy way to have that intro conversation, and why I love it. So.
Yeah. And what I really liked was you gave the alternatives, the cross purchase or the LLC that would hold those insurance policies. A great opportunity to kind of go a little bit deeper than with the client with an actual solution set. I'd like to, let's see if there's any final questions at this point. And while we're waiting to see if anyone has any questions, and go ahead and feel free to type those in into your chat box. Also, all the attendees are in a drawing for a CE voucher and a Starbucks gift card. Let me see here, Ryan. I don't see any questions. Looks like you nailed it. But if you could, Ryan, we want to give away that CE voucher and Starbucks gift card. If you could pick a number between 1 and 26.
Ooh, good. How about 14?
14. Okay. Jeff Doom, you are the winner of our Starbucks gift card and CE voucher. Congratulations. I would like to remind everyone that we do the brew every Wednesday and really try to provide, just like Ryan did today, some really good information in a short amount of time that you can take to increase your business. Next week, we're going to welcome John Hancock's in-house long-term care expert, Jennifer White, to the brew. And Jennifer's going to share with all the attendees the topic of the state long-term care initiatives and what they mean for both you as an advisor, a producer, and your clients. This will include how to assist clients in developing a plan and preparation of decision making during a time of crisis. Um, let's see. Again, I see no further questions. Ryan, thank you very much for your first time on the Brew. We hope to see you in the near future, and I hope to see everyone else that joined us today on the Brew. Have a great afternoon and a great rest of the week. Thank you for your business.